All rise. The Court of Appeals Division 1 is now in session.
Please be seated. This is the time scheduled for oral argument in our case number 1CA TX140010, Phoenix Cement Company v. Yavapai County. Both sides have been allocated 20 minutes for oral argument. If the appellant desires to reserve any time for rebuttal, you may do so. But you have to manage your own time. The time left on the clock at the podium includes your rebuttal time. To assist you, you should be aware that we have conferenced this case. We've read the briefs. We've looked at the pertinent statutes and law. We have, as well as the arguments made. So if you completed your argument and you have time left and we don't have any questions, you can feel free to sit down. Finally, you should be aware that we're recording these proceedings, both orally and visually. So two things. One is when you approach the podium, please identify who you are and who you're representing. The second is understand that you are on camera. You'll be able to view the videos, I believe, on YouTube in several weeks. So with that, counsel for the appellant.
May it please the Court, Susan Freeman, appearing on behalf of Phoenix Cement. I would like to reserve 5 minutes for rebuttal. The primary issue in this appeal is, of course, economic obsolescence. If I may, I'd like to spend just a couple of minutes at the beginning with respect to the error correction statutes, because otherwise I know I may not get there. And that's the subject of 2 supplemental citations. So let me just note that the tax court relied on ARS 42-16-255 to say that the additional materials, that the additional assets, escaped property could be included in this appeal. That statute talks about an appeal under this article, which is Article 6, and that is the error correction statute. And it talks about when a proposed correction or notice of claim has been filed, neither one of which were filed in this case. The subpart B of that talks about a judicial appeal regarding the subject property and an error that was already the subject of a notice of correction, already the subject of notice of claim, again, assuming that one had already been filed before this appeal was going forward. Those are to be adjudicated. We did not have that in this instance. The counterpart statute, 42-16-212 in Article 5, which is a section dealing with the annual assessment appeals, which is what we actually had pending. That one talks about you may present evidence regarding any matters that relate to the classification or full cash value, not error correction, but rather full cash value in an annual assessment appeal, error correction in error correction appeal. That's what the new Levy case that we included in the supplemental citations addresses. The county included another provision or another case, Pima County Assessor v. State Board of Equalization. That one has been distinguished by Levy. It was a 1999 case and depends in part on 2014 amendments. And we, of course, do not even have a pleading amendment. This came in on an expert report. It was not properly before the court as a matter of procedure as well. So let me, unless anybody has any questions on that, let me turn to the economic obsolescence.
I had a question for you on the penalties and or interest rate that would apply to that escaped property.
Right.
Would any interest rate apply or any penalties apply?
No, Your Honor, they would not. First, the escape property wasn't properly addressed here. And one of the statutes, the statute on which they relied, the 42-15053, says property that has escaped taxation must be determined the taxes due plus a penalty or after the taxes are determined under Chapter 16, Article 6, which is the error correction procedures. And we never went through the error correction procedures, so we don't get to that penalty.
As far as the error correction procedure, once it's determined that there was escaped property,
Right.
are you saying that the taxpayer could fail to list the property, then either gets caught or it finds this error and doesn't have to pay any interest once
No,
it's-
no, no, not at all, Your Honor.
So what
No.
interest applies?
Interest applies only after you've gone through the error correction procedures,
understand that.
if in fact that's determined. I mean, it may be determined there that a railroad spur is real property. It shouldn't be part of this at all.
Would it just be the normal interest rate, not the 16% interest rate?
The 16%, I don't think the 16% interest rate would apply. It certainly wouldn't apply until you have an assessment. So after you determine the interest rate error, then it gets on the tax rolls, and then we have an opportunity to pay it.
Right.
And it's only if we don't pay it at the point that it is assessed that the interest rate
It's not like
applies.
the taxpayer doesn't have to pay any interest by failing to, after the error correction procedures are used.
After the error
It has to
correction-
pay some interest on its failure to list the taxes.
If it does not pay once it's on the tax rolls, once it's on the tax rolls, then the interest rate under this statute kicks in. But we have an opportunity to pay as soon as the determination is made legitimately and under the statutes that we owe it.
Saying no interest is paid, no interest is owed, taxpayer can intentionally, let's say, fail to list property.
Well,
And then 2 years later, they get caught. I'm not saying your client, it gets caught. And there's, oh gee, yeah, I got caught, but I don't have to pay any interest on that because it never was on the tax roll.
There is a separate statute with respect to intentional failure,
Okay.
and that's addressed in our reply brief. There you have the additional 10% penalty, which is pretty stiff. The interest is only once you actually have a final determination as to the amount due and it's on the rolls. But you do have that big penalty if it was intentional. So let me turn to the economic obsolescence, which is really the main issue here. The taxes get assessed year by year, and in any 1 year, the court is to determine, or the assessor is to determine the full cash value. Full cash value, as we know throughout Arizona, went down for real property taxes. It went down significantly, and it is the same for personal property taxes. Full cash value means the same thing in each instance. The amicus brief showed the extent of the decline in the full cash value with respect to real property. Here, we have a personal property owner whose business is dependent upon real property construction.
In that regard, counsel, it seems the way I read the briefs and the record, the drop in value that you contend is hinged on this purported loss of production, right?
Yes.
So you use a comparative year of 2005.
Correct.
And then compare the tax years to that to demonstrate, in your view, this loss of production, which translates, in your view, to a loss of value.
Correct.
The way I read the county's argument was some suggestion that perhaps the taxpayers' selection of 2005 year was inappropriate, that there'd been a tremendous ramp up in production, and that skewed the numbers for purposes of comparison. So I'd like your take on that, please.
Certainly, Your Honor. The reason that 2005 was used was that under the inutility penalty, the method of determining, you have to compare capacity to the actual production. And so in order to determine capacity, our expert did not look to the theoretical capacity, instead looked to the highest actual capacity. The actual use was 88% of the theoretical use, and that was in 2005. So he said that's capacity, the most capacity that they've ever had. That's what they could do, and then you determine what they were actually doing by way of production. I would note to the court that under the Eurofresh case, Eurofresh is recognizing that you can have temporary economic obsolescence. And in Eurofresh, you had the expert coming in and saying, oh, you have a 40% reduction in these comparables, and there was no evidence that tied it back to the actual taxpayer at issue. But in Eurofresh, the court said, look to Indiana cases, and in the Indiana cases, let me find it here.
Counsel, let me just ask a question. I want to kind of follow up on
Sure.
Judge Winthrop's question. The trial judge was presented with a calculation by your client, and that calculation, the judge had some questions about your baseline of 2005. One could argue maybe it might have been a fairer, more valid approach to maybe average the capacities from 2000 to 2005 instead of picking the top greatest capacity that was ever used in the history of the plant. But it's those kinds of things, and there seems to be some other things in the record where the judge was left with a choice of accepting a calculation of 50% reduction in 2010, 60% reduction in 2011, the 2005 capacity year as the baseline. There weren't any income numbers in terms of profitability of the plant, and so the judge had that choice, and on the other hand, he had the choice of the full assessment that was provided by the county. And if he had questions about how you arrived at that number, and he had no other mechanism to maybe arrive at a lower depreciation number, a lower economic obsolescence number, then maybe he might have been able to, within his discretion, conclude, because your number was so high, that you didn't overcome the presumption of the validity of the county's assessment. Have you thought about that? Because,
Absolutely.
And I'll tell you exactly where I'm coming from this. I mean, I was a trial judge for many years, and sometimes I would be given an either or. I have one expert, and then I have another expert. There's nothing in between. So the judge has to pick. And I don't know if necessarily what the judge did here was reject the economic obsolescence argument. He just rejected the calculation that you had.
Okay, there are several points within that, so let me try to address them all. First,
Sorry, I didn't.
No, that's perfectly fine. I want to answer your questions. First, what the court did here was not enter findings of fact saying, I believe I believe that the testimony of the defendant's expert, the county's expert, was in fact the appropriate amount. What he did, if you look at the under advisement ruling that is dated 3/17/2014, he makes a determination by saying, here are my observations about economic obsolescence. The existence or non-existence depends upon normal variations in the business cycle. The court is of the opinion that is neither supported by existing law nor justified on public policy grounds. And then he goes on to explain in more detail about why he believes that, because this is normal economic fluctuations like seasonal marshmallows production, and says, based upon the foregoing and the evidence, I'm entering these findings and conclusions. That's really a determination as a matter of law. And so to the extent that he's saying, I don't believe that the Phoenix Cement's experts' opinions are valid, the only reasons that he gives are that he's making determinations about economic obsolescence based upon fluctuations, a downturn in the business cycle that can be followed by an upturn in the business cycle.
Temporary economic obsolescence, you're saying. He made a determination there can't be.
But there can't be, because that's a business cycle. If it's going to go down, it will go up again at some point, and there's no question. It will go up again at some point. It's finally going up again. Finally, our real property tax assessments are going up. We see those. And personal property ones.
But what about my house values? They haven't gone up. I'm still waiting.
Mine got a little bit of an increase, but okay.
We can assign ours to you.
But okay, so you have the court's determination that because it can go up again, that's just a business cycle. It was not recognizing that there's a difference between seasonal fluctuations for a marshmallow factory and the Great Recession, even though you have cases all over, including the recent Gravois case that we cited supplementally, even though we have kind of a defiance of logic that in fact there would not be a significant decline in personal property like real property when you have the Great Recession, and change of the evidence. But then let me go to how you prove that, because we did not have evidence in here, in this record, with respect to economic losses, operating losses, and the reason, as explained by the experts, was that income is dependent upon not just the personal property and its value, but also dependent upon real property values and accounts receivable and what they were, not only what they were selling in different places. It included a number of factors, and that's why you don't have an operating income.
Can I ask you a question real quick?
Yes.
In looking at Judge Fink's finding, I understand your construction of what he says here. Is another way to construct that language, he's not ruling out that there could be temporary economic obsolescence. He's saying that it has to be something above and beyond normal variations in the business cycle. I mean,
and to that extent, that is what the evidence was clear, that it was above and beyond.
I understand that that's the argument. I'm saying if we construed it that way, then he wouldn't be making an error regarding Eurofresh or what the state of the law is, would he?
If you're reading it that way, I appreciate that, but I believe if you read the entirety of what he says, he's saying that whenever it's going down, then it can't, the fact that it can go back up means that it's not really economic obsolescence. Plus, he says that when looking at page 2, he says for personal property, values based on the acquisition cost, here the purchase price, and the price for any productive good in an efficient market is the present value of the income stream. So he's taking the purchase price, which is not in fact the method for determining personal property value. You take the original cost and you increase that based upon various factors to come up with replacement cost new today, not what it cost back in, the 1900s and 2005. And then you depreciate, and then you add other factors, and that's what the manual says. You don't take the potential income stream. This was not a depreciated income stream calculation. It was not a comparable sales and purchase price calculation. So he's mushing all those together. And the determination of personal property value is as under the manual. You figure the replacement cost new, you take depreciation, and then you determine whether there is extra depreciation, extra factors, including, as it said, because of a loss in demand, economic obsolescence. With respect to the determination of the amount, I would ask the court to look to the cases that were cited in Eurofresh, which is recognizing the temporary obsolescence. It's quoting an Indiana case where the taxpayer proved economic obsolescence when the property showed a decrease in the property's income generating ability. And then likewise said another case, you had an almost full building, can't show that the alleged causes of economic obsolescence showed that that property caused it to experience a loss of earning capacity. So here we had the loss of ability because the silo is full. We can't put in anything more. Nobody's buying. We had to shut down entirely for 5 months in 2010. 5 months for 2009 because there was no sales. So when you're talking about property, you're talking about the capacity to sell, not whether or not there was an operating loss. And I reserve the remainder of my time for rebuttal.
Thank you, counsel.
Thank you.
May it please the court, counsel, I'm Roberta Livesay, and I'm arguing on behalf of Yavapai County. I'm not sure exactly where to begin in order to focus in on some things that seem to be concerning to the court and might be a little bit loose here.
Let me try to help a little bit.
Thank you.
What about the language from the trial judge? You know, there is some language that he has in the first and second pages of the under advisement order, where it could be viewed as saying temporary economic obsolescence as a matter of law isn't recognized as a grounds to depreciate, I guess, the full cash value. I mean, how do you interpret this?
The way to interpret it, Your Honor, is by looking at the totality of what Judge Fink was saying in this under advisement ruling and the evidence that is clearly set forth in the record. I think one of the ways that it might be most helpful is by looking at footnote 1, which is on page 2 of that minute entry. The judge is referring to the business cycle as being outside the control of the plaintiff or any other market participant, because remember, that's one of the criteria for economic obsolescence. It has to be out of the control of the property owner. So the judge is acknowledging that the business cycle is out of the control of the property owner, and then he says, for this reason, plaintiff's assertion in paragraph 64 and 66 of its proposed findings of fact that the mass appraisal approach is inadequate to account for the market decline is unfounded. There's a lot packed into that sentence. First of all, the judge is recognizing that the Department of Revenue depreciation tables do contain an adjustment for market-wide economic obsolescence. That's what the mass appraisal process is based on. Remember that personal property is a self-reporting taxation system. I've cited at page 49 of the answering brief the statutes that direct the taxpayer in the first instance to fill out a form and report all of its personal property that's attendant to the location in which it's citing. And then the assessor, in the case of locally assessed property, takes that self-reported list with its acquisition cost and applies the Department of Revenue tables. The testimony at trial from the county's expert and from the statutes and the tables and the manuals was overwhelming that economic obsolescence at least is purported to be included in those tables.
I don't see how that can be, because those are standard depreciation tables. That's just the market cycle. Almost by definition, it doesn't seem to include like extreme market fluctuations.
It doesn't include anything out of the ordinary. But
Isn't that what temporary economic obsolescence is? Is something out of the ordinary? Like
no, Your Honor, it is not anything out of the ordinary necessarily. But here we have to remember who has the burden of proof. The only proof, the only suggestion that the plaintiffs offered was that they didn't think that temporary external obsolescence was accounted for in those tables. But they did nothing to prove it, whereas our expert went through the reasons why he believed that it was included, and even the plaintiff's expert had to admit that the tables purport to include them. So the presumption of correctness goes with the county. The plaintiff has to come forward with some facts. They would have had to have gone behind the numbers, analyzed what went into making them up. All that data is out there. It's complicated, it's time-consuming and difficult work, but it's all out there. And you can find exactly, if you believe that Marshall and Swift provided the data, you go to them and they get reports from all of the market participants and they analyze them. And you can, and that's why you get an expert witness. You can do that work and rebut it if you think it's rebuttable.
But they did present some evidence regarding the market, and they did the in-utility analysis. I mean, it's not like they didn't present any evidence. Perhaps the judge didn't think that evidence was convincing, and he found that your expert was more convincing. But can you really say that they didn't present any evidence?
The in-utility formula is a formula. It's not evidence. It's kind of akin to what we had in the Eurofresh case. In Eurofresh, we had an expert who went directly to the formula and applied it without tying it to the place. But here we have the expert using a formula to calculate external obsolescence.
He did, though. He used data from the production capability of the plant to plug into the formula. They used data from 2005 in terms of 88% capability that they used. That was their best year. And then they plugged in data from 2010 and 2011 that they were operating at a lower percentage. I mean, it's just I understand the formula is a formula. You have a baseline, and then you have a number that you plug in for a given year, and then you come up with a percentage. But
remember, the judge also said that he didn't think that their expert necessarily followed standard appraisal methods and techniques. We have a lot of discussion in the briefs and even more at trial about the text, the appraising machinery and equipment text that their expert helped to author at one point in time. This text says that you use an income approach to calculate temporary external obsolescence. I think the briefs from the plaintiffs are confused on this point. They say, oh, the county's accusing us of not doing an income approach to value. No, what we're saying is, having observed temporary external obsolescence, the expert should have gone to the techniques provided in the text, which is the income approach primarily, and even the cases they cite rely on the income approach, to calculate the temporal limits of that external obsolescence. He didn't do that. And if you don't do that, you are essentially saying this economic obsolescence is permanent. Now, the expert here calculated with, when you take off his 50% and his 60%, he's left with a plant that I believe, and I might be wrong on the numbers here, would be capable of producing 430,000 short tons a year when the plant capacity was more like 800,000 tons. And please forgive me if I got the numbers wrong. And I said to him, so that's basically what you're opining to here, is a plant with that capacity. Yes, he says. So who would build a plant with that capacity? Oh, nobody would. It's way too small. And this plaintiff actually engaged in activities under its control to expand the capacity of the plant. It was 1,700 short tons per day before they underwent an expansion that raised it up to over 3,000 short tons per day.
That some of that's getting permits that take like 10 years to get approved. The fact that they started the process to expand the plant and some of those things, is that really evidence that they expected in the immediate future to be able to produce at that capacity?
They never expected in the immediate future to produce that capacity. There's articles with admissions in it from their own people saying, we don't need this capacity now. We are planning for the future. And that forward-looking, that anticipation or future benefits, that's at the crux of property appraisal. Whether it's real property or personal property, it's always forward-looking. When someone comes in and buys an apartment building, they don't buy it expecting to get what it generated in the past. They look at the past to inform their expectations for the future.
Well, counsel, and this is, I guess, a point I gleaned from at least your supplemental authorities that you submitted to us. Your position is that regardless of what the piece of equipment's value is for the subject tax year, if there's the possibility that its value will increase, then it can never be the basis of a temporary economic obsolescence claim for enhanced depreciation. Am I generalizing it too much?
I think you're generalizing it too much. When you're claiming temporary economic obsolescence, you have the duty, the obligation to opine how long you think that temporary obsolescence is going to last. So if you think it's worth X now, but it will be worth Y in the future, then you take that future value and you discount it back and you do the things that appraisers know how to do to come to a present value. That was also missing here. He simply gave us a calculation based on inutility with no recognition, even though he said it was temporary. He gave no recognition to the temporal limits.
So I guess you agree, at least in the abstract, that a drop in supply and demand can be the basis of a temporary economic obsolescence claim.
Yes. And once you make that claim, you have the burden as a taxpayer to prove that the Department of Revenue tables do not account adequately for what you are claiming is your temporary economic obsolescence. This comes down to proof. This comes down to evidence in the record. The court used the right standard. The court understood temporary economic obsolescence, but said that the plaintiff failed to meet its burden of proof. And the court just didn't go along with what the plaintiff's expert had done. Let's see. Yeah, there was a lot of conflicting evidence. I'm not saying that they didn't present any evidence. The evidence was conflicting. The judge weighed that conflicting evidence and made his decision and applied the facts to the correct law. So having a record full of conflicting evidence, as long as there's sufficient credible evidence to support the trial judge, then his decision should be affirmed on that point.
I was a little confused by Judge Fink's use of the marshmallow bunny example in his minute entry. I mean, that seemed to me, and maybe what he was saying is, here's a classic scenario of a curable production problem, not governed by external factors alone, but rather one that the taxpayer could voluntarily ameliorate. But the suggestion, I'm not sure if the judge was suggesting that that applies to this taxpayer. I mean, what is it about the Phoenix Cement production scenario that makes it similar to the marshmallow bunny example?
I hate to try and go behind the words and say what was going on in the judge's mind, but there was evidence at trial, and we cited it in our opening brief, that even during the two worst years that were presented to us at trial, the plaintiff had months in which they were operating at peak capacity. They could not have met the demands, and their witnesses admitted that under cross-examination. They could not have met those demands of those peak months without the capacity that they had increased prior to the tax years at issue. Because remember, there's two different scenarios of increased capacity. One took place and was fully functioning before these tax years became at issue. And the other one was a projection. The other one was a plan to increase even beyond what they were doing. And then you have to remember all the other evidence in the record of the market for cement. It was expanding production capacity even as the sales were down. The Drake cement plant came online just down the street, literally, from the subject property. And we had lots of testimony concerning other plants all over the country and in Mexico that were increasing capacity at the same time, or planning to increase capacity. So this is where that necessity to calculate the temporal limits of the subject property's temporary economic obsolescence come into play, because certainly there was a market out there. And there were willing buyers willingly spending money to increase capacity and buy similar machinery and equipment, even while this taxpayer is saying, you shouldn't tax us for 50% of it. Wait until next year or the year after that, and then you can tax us for all of it when things improve. But right now, don't tax us for it. But they didn't do the calculation. They didn't meet their burden of proof. I could argue to you why I think that that theory is wrong and take up a lot of time. But the fact of the matter is they didn't do the work necessary to provide the credible evidence to support even their theory, which I think is flawed.
And just so I understand that, your position on their failure to meet the burden of proof was where? Was it in the demonstrating the effect or the impact of the economic recession on income, on production, on what?
It could have been any of those things. It would have been a choice for them with their expert witness to determine which way to go. The preferred method is the income approach. If you even look at Eurofresh, that turned on the fact that they were projecting $100 million for their values to their potential lenders and then saying $50 million to the taxing authorities. And with that $100 million offering, they had to produce a lot of income and expense information along with it. So we were able to show that they weren't suffering the obsolescence that they were claiming. But here, they didn't even attempt to provide the information that would have distinguished this permanent obsolescence their expert was opining from the temporary obsolescence that he identified it as being. So he gives us a number for permanent. He says it's temporary, but he says, you taxing authorities, you people of Yavapai County, you are stuck with this as a permanent reduction in this tax year.
And just so I understand, I mean, one of the alleged failures here was their experts' did not project the end to this decrease. And you think that's important to allow for the calculation of present value of the loss?
If I can draw an analogy to another standard appraisal method and technique, and I think you'll see it referenced in some of the cases that were cited, it's called the discounted cash flow method. And you project income out over a period of years, typically 10 years for an office building, an apartment building, and then you discount it and you bring it back to a present value. That is the approach that should have been used in order to quantify the temporal limits of this external obsolescence. And Mr. Nielsen, Phoenix Cement's expert, agreed that that is a standard way of doing it. He said he knows how to do it. He just didn't do it here. So I do think that that is one method that they could have used to calculate that temporal limit. The fact of the matter is they didn't do anything. So the other questions that occupied a lot of time this morning had to do with the error correction statute argument. The error correction statutes are remedial. They're backward looking. Judge Fink did cite one of those statutes in his under advisement ruling, but he cited it for the proposition that exhaustion of administrative remedies is not necessary. The better statute to have cited is the one that we cited, and it's in the 1500s, and yeah, it's 15. It's in our brief, and I'm sorry, I can't put my finger on it right now. But it says as soon as an audit is conducted, that property is taxable right then and there, and that's what their big complaint is about our expert. Oh, he only audited. Well, he did audit. He did more than that, and he found it.
Isn't one of the advantages of following the error correction procedure, the parties can go back, I'm assuming if it's inadvertent or a non-intentional error, they can get a valuation on the escaped property and possibly negotiate doing away with the penalty, those types of things. Whereas if you just load it into the tax appeal, like here, like this case, there really is no ability to do that, is there? Or you lessen that ability? Do you agree with that or no?
I don't think I need to agree with it or disagree with it, Your Honor, because the legislature hasn't seen fit to put that mechanism in there. Instead, they've given us a very clearly worded statute that says it's taxable right away, and we're talking about current year taxes here. We're not this assessor is not trying to go back in time and tax property for tax years not the subject of the appeal. These are current year taxes, and I had to really talk to myself about whether or not I was going to say this, and I think I'm going to. Their cases, their authorities are trumped, pardon the use of the word, by Pima County Assessor versus Arizona State Board of Equalization.
Oh, trumped. I thought you said drunk. I didn't understand.
I'm sorry.
No, my hearing's bad. I'm sorry.
And I'm rushing. But that case says specifically that during the course of an appeal brought by a taxpayer, if the assessor finds unreported taxable property, it's taken care of within the course of the pending judicial appeal. You don't have to go back and use the error correction statutes. We're talking about a gigantic piece of machinery and equipment here. The blending sweetening equipment, it's about as big as half of this room between here and there. I saw it when I was out there. Let's just say it had been on the property for tax year 2008, and it had been unreported going back that far. I would not advocate that the 2008 issue be reopened during the course of the trial that we had for these tax years, because that would be backward looking. We are not looking backwards here. We're just saying this property was on the premises as of the dates of value that you sued us for. And according to the case law and the statutes, it needs to be a part of this litigation. And the penalties and the interest apply from the date that they should have been reported, as the tax court found. I know I'm out of time, so unless the court has any more questions, thank you.
Thank you.
Let me first address Judge Gould's initial question to me with respect to the court being able to make its own determination as to what the underlying facts were and whether other facts in the record would support it. Your Honor, because we invoked Rule 52, the findings of fact are to be here, and you can't assume that there were other facts that would have justified it. What we have instead is the court's ruling, and I would ask the court also to look to page 3, where the court says recur they are known to do. The prices are built in. The effect of the business cycle is factored into the purchase price. And on page 4, where the court says that fluctuations in the business cycle, which would generate economic obsolescence frequently, indeed under Nielsen nearly always, if business cycle fluctuation is in fact a valid basis for economic obsolescence deduction. He's saying he doesn't believe that that is the law as a matter of Arizona law or Arizona policy. The notion that you have to determine when the Great Recession is going to end, when politicians and economists and the Federal Reserve couldn't figure it out, is really something. But the important point, I think, is that she's giving us a reason that it needs to factor into the discounted cash flow, figuring out the income approach and how much you should discount. We must determine when this reduction in demand is going to end in order to discount. But we didn't use a discounted cash flow approach. That's not the proper approach. That is an approach. The inutility formula is a better approach, and our expert explained why. I guess I would also note perhaps that if you look to the Aspenhoff case, which is one of the others that was supplementally cited by the county, it explained why the method there was using replacement cost new, so the fact that it was losing money in an income approach is irrelevant. You don't look to that. You look to the actual method of computation, and utility is a standard method, and that was provided, and we attached the sections of the book that provide for that to our brief. With respect to the burden of proof, part of this comes back to the fact that we had a very qualified expert, and the only reason that the court said it doesn't agree with it is because of the reliance upon the economic obsolescence analysis. But the county did not have a qualified expert. The county had an auditor. An auditor is like a surveyor. They look at the numbers and they compute the cash numbers and compare it to the tables. But they don't know how to do the extra step of doing an appraisal and determining fair market value. That's not what they are trained to do. He didn't do an appraisal, didn't know how to do an appraisal. So when the court says as a general conclusory reason why it would be accepted, he said, well, he must know how to do it because he's been involved in tax. He didn't know how to do it. It was not that he must know, he did not know, and the court should have excluded that information. Thank you.
Excellent. Thank you. Thank both counsel for their arguments. We will take this matter under advisement and issue a written decision in due course. With that, we stand adjourned.